Good afternoon, everyone, and thank you for joining us here today. We've got a very special episode. We're actually coining a new term for this. It's not a webinar, it's not a podcast, it's a podinar. It's the OZ Podinar. All joking aside, thank you so much for joining us here today. My name is Dennis Serdenko. I'm the head of sales at OZ Capital. My esteemed colleague Oleg Schiller, the CEO and co-founder of OZ. And we've got somebody else here with us today, Mr. Yaron Orgil. So Yaron's kindly decided to join us and on our discussion and our quest to educate the Canadian public about alternative investing. So a brief bio here. So Yaron's been in the industry for over 20 years. He has learned that nothing is more important than family and personal well-being. That is what drives him, and it is what drives his clients as well. This is at the core of his beliefs and what motivates him to provide the best service possible to his clients. So Yaron has built his practice around a select group of high net worth families and successful entrepreneurs, helping them make sense of the intricacies that come with their growing wealth. Yaron and his team apply a unique set of strategies for portfolio diversification, tax optimization, insurance, and debt to protect clients' legacies. The aim of this team is to handle day-to-day decisions for clients so that they can focus on their family, their career, and doing the things that they love. So Yaron runs his own business and is a portfolio manager and senior wealth advisor. So that's why we thought it'd be great to bring him on here today to start our discussion about alternatives.
Thanks for having me.
Absolutely, it's a pleasure. I'm going to take a back seat on this one. In fact, both Oleg and I are going to take a back seat. We're going to sort of co-host, and really let Yaron take the reins on this. But just to set the stage a little bit, again, the importance of alternative investing in today's market, I think, will be sort of our first unofficial section. We'll explore alternatives in a little bit more detail, the types of alternatives that are out there, and then followed by sort of how would you incorporate alternatives into your clients' portfolios and for our clients as well. So I think I've been rattling on for a good amount of time there. Gentlemen, let's talk about alternatives.
Absolutely. So I guess I'll start with the first question. So alternatives and alternative investments is such a massive field, and it's getting ever so large and vast in Canada, which we're so happy because we genuinely believe that we need to provide clients with various options for diversified portfolio. So specifically having to do with alternative investments for your clients' investments. Are there any specific criteria that you look for when you're evaluating and selecting an alternative investment for their portfolio?
Absolutely. Look, and I think it's important to even step back and just see how the environment has changed. If you look back 20, 25 years ago, and you look at some of the top pension funds and endowments, Canada Pension Plan, Ontario Teachers, they're very large institutions that manage hundreds of billions of dollars for Canadians. If you look back, for example, in 2020, CPP had, I believe, approximately 80% of their portfolio in fixed income and about 20% in equity. Teachers was a little more aggressive, if you want to call it that. They had about 60% in equity, 20% in fixed income, and 20% in what they would call inflation-sensitive investments. And those would be real estate, commodities. Very traditional, if you want to call it that. Fast forward to 2023, 2024, depending on when you're looking at their asset allocations, they now have probably 50% of what you would deem non-traditional asset classes, alternatives, right? You have your traditional fixed income, your equity, your public equity, but now you have alternatives, and you have what are alternatives? You have private equity, you have private debt, you have mortgage investment corps, you have real estate, and I mentioned that already, inflation sensitive, you have commodities, you have all these various asset classes that an investor can use and have access to. Now, traditionally, and historically, I should say, those have been primarily suitable for institutional investors. The average investor was not able to access those. What we've seen over the last 5 to 10 years is the proliferation of these opportunities and access for individuals. So what comes with that leads really into your question of how do you determine what makes sense? And it's a difficult conversation because there's a lot of factors that come into it. Your risk tolerance of the individual, the time horizon. You know, many of these investments have long durations. So if you have an investor coming and saying, I need money in 6 months from now, well, obviously you're going to be looking at a cash-like vehicle because you want to manage the volatility and the liquidity. So there's a lot of factors that will drive how you input it into a client portfolio. Age of the investor, right? Are they in their 70s or 80s? You probably don't want to invest in something that's got, you know, in a pre-development real estate opportunity.
Of course.
You know, you're in a situation there where your payback is probably 8 to 10 years. That's not necessarily suitable. Conversely, someone in their 40s or 50s, that is more suitable on the time horizon. However, their need for cash flow might be different. Young family, potentially mortgage, maybe one spouse is on maternity leave because they have a young family. All those factors can play into timing and the right allocation size.
Let's have a conversation about, you know, what are alternatives, or as I think you like to refer to them as non-traditionals, because again, you know, we have this thing about not assuming, Oleg and I, and you know, never assume that everybody knows what we're talking about, right? We're talking about some pretty sophisticated stuff. So why don't we take it back a little bit, and like the great information, but in terms of like, so what is an alternative? What you know, why, and in today's landscape,
Sure.
right? Like, why are they becoming more popular?
Absolutely.
So for the layperson, right?
Yeah.
Let's talk about it simply. Cause I know, like, my mom is probably watching and she's going like, what the heck?
Yeah.
Because she watches all.
This
of
gets a
it.
bit more complicated than that.
But that's good, that's why we're here to educate, right? So what's an alternative, like, or no?
Yeah, and look, I think there's a lot of ways, you know, to me, and I think everyone has their own interpretation. To me, an alternative is anything that is not a publicly traded security or of either equity or fixed income. So, you know, it's not.
not a stock,
Not a stock or not a bond,
Yeah,
exactly.
yeah.
Now, you can go back and you look, you know, what did CPP identify as alternative or private markets or teachers back in the early 2000s? And what's amazing, if you actually have the time, and I don't necessarily recommend you do this, but if you go look at their annual reports, and you look at their annual reports today,
Mhm.
they're probably 150, 160 pages long. You go back to 2020, they're about 25 pages long.
Right,
So obviously the complexity has grown, and why has that? Well, there's a couple of things. One, you know, if we look back even 8, 10 years ago, or not even, like, let's go back 5, 6 years ago, just around the time of the pandemic, interest rates were at historic lows.
Right.
So people looking for yield couldn't get the same yield that you could get in the 1980s
Mhm.
from a bond. In the 1980s, you can get 20% for a GIC. In 2001, you were getting 1% or less. Today, you're getting, again, 4.5%. So we're kind of back in a, call it a normal state
Mhm.
for that fixed income. But when people are craving yield, they're craving that opportunity. So that's one aspect of the alternative, right?
Right.
And that's the income or the yield component of the alternative or the non-traditional. Then you also have, you know, if you want to call it the private equity side or that aspect of it. And again, if you go back 15, 20 years ago, companies, as soon as they could, they would go public. They would join the TSX, the S&P 500, the NASDAQ, and they would be a public company. When they needed to raise more capital, they would go to the capital market and they would raise money. Fast forward to today, companies are staying private for longer. You know, whether it's, you know, SpaceX or many of these other institutions that stayed private much longer, and they're able to raise money in the private realm as opposed to coming to the public markets.
Mhm.
Why do they do that? There's many reasons. One of them being they don't have to go through the scrutiny of being a public company.
Right.
They don't have to deal with public
Regulators.
shareholders. Well, and regulators, I think you should always deal with. I think that's an important aspect because that's a checks and balance.
Right.
But when you're dealing with when you're dealing with shareholders, look, you get earnings. Apple, you know, Apple sells 10 million iPhones, but analysts wanted 12 million.
yeah, yeah.
Stock is
So
down
they not the
25%.
expectations because of something
Exactly.
like this.
Whereas when you're a private company, you don't have to necessarily deal with those same day to day. You can plan for the next quarter century as opposed to the next quarter.
Right.
And that's a big difference in how you manage a business.
So there's, in essence, more flexibility with a private company in terms of specifically decision making versus when you're public, you're specifically have
You're bound to.
10,000 more eyes looking at you and telling you, no, we don't agree with your ideology. I mean, we suggest shift something like this and be more endorsed and not.
Absolutely. You look at these large corporations, some of them are owned, Warren Buffett, fantastic investor, genius of one of the greatest investors of all time. There's companies he owns 8, 9, 10% and more. He has an influence on what that company does. That's not to say he's wrong. And in his case, he has a lot of value, but there are other situations where you have funds or you have other investors that own such a large piece of that company that they can drive decision making. Sometimes it's good, sometimes it's not. And when you're a private company, you're not as beholden to that. You as the executive team can run that business as you see fit.
So in terms of one thing that I often hear about is this concept of sort of correlation and like again, when we think about it in terms of constructing a portfolio, right? So as you pointed out, some of these big institutional investors like the CPP or the teachers plan are big users of this. I kind of know the answer to this, but I want you to go through it because I think it's a pretty key thing. The reason they use these is because they have to have a predictable cash flow, right? And that helps with correlation or with non-correlation.
Yep. That's a big part of it. You want the predictability. We also want the avoidance of the stepping on a landmine analogy, right? Or I like to use the analogy of I have 5 or 6 buckets. If one tips over, it's not as big a deal. If I have 1 or 2 buckets and they tip over, that can be pretty catastrophic to a portfolio. If you know what's going to happen, and the way to generate true wealth is through concentration. You look at Bill Gates, Steve Jobs before he passed away, Bezos, all these people, Elon Musk, they created their wealth through concentration. They owned one very investment and it grew significantly. That's fantastic for them. Many people don't have that luck or that opportunity to create wealth through a concentrated position. So how do you ensure that you don't go the other way? You diversify your risk. So going back to my buckets analogy, if I have 5 or 6 equal weighted buckets, I feel like I'm diversified. I can't, even if one gets knocked over, I can redeploy some from the other buckets to refill it. Right. If one bucket starts to do very well and performs exceptionally well, you take a little bit of profit off that and you sprinkle it to the others, hopefully growing your overall wealth over time.
So what's interesting, what I find with pension funds specifically, and there's a very little exposure knowledge that I have is, it's an actuary business in essence where they have to see how much money is actually going into the pot and how much money they have to keep distributing. And as they look years down the road, they have to generate a very specific rate of return to make sure that they can meet these withdrawals that are coming in, especially in today's environment where probably one of the biggest challenges is for how many people are going to continue contributing and how many people are going to retire. So they have to make sure that the fund doesn't end up with 0, which eventually pushes them to optimize their yield. And yield optimization has to do with the tactical allocation of the type of products that they're selecting for their diversified portfolios and other advisors that they use. So specifically, what I do like about alternatives is you take an alternative look towards other industries where you can generate that specific rate of return. In the alternatives, the concept of illiquid is what's important to mention, where you may not necessarily have your money tomorrow. It's not like a guaranteed investment certificate where it's defaulted back to the capital markets where you just trade the money comes into your bank account. So this is where you exercise spending more time on evaluating if this is the right opportunity for your clients as well, right? So this is where the pension fund is a bit more sophisticated. But going back to an individual portfolio, an individual who's one of the clients or a potential client looking to partake in the alternatives, how do you educate them as to what is the right alternative product for your portfolio? We're big believers in educating, but what steps are you taking towards that?
Education is an ongoing. It's never one and done. I think it's first having a conversation with those clients or those investors in general, just understanding what their goals and objectives are. Right, that's step one. You talked about the illiquidity of alternatives. There's a concept of the illiquidity premium, meaning you can get a higher yield or a higher return for that illiquidity. However, when you talk about a pension or an institution, CPP is infinite. It will in theory live on forever.
Yeah.
We all have life we have finite lifetimes.
Yeah.
We also have things that happen to us that doesn't happen to a pension fund. Unfortunately, we may go through a divorce, we could have, we may have to sell a home, we might lose a job, we retire, all
Life
those things.
events.
So exactly, all those life events that the institution doesn't have, so you have to manage that, so. The education is really understanding the clients or the investors and what they're looking for. And then walking through what the objective of that investment is, how it compares to maybe a non-illiquid alternative, if there's one. Using real estate, for example, do you buy a private real estate investment versus buying a publicly traded REIT? What are the differences? What are the pros and cons to both of them? So that they understand why is it better or worse potentially to buy the private one versus the public one? What are the wins that you might get from one or the other? What's the liquidity? All those factors will come in. So the education is really dependent on the individual and the product, because some products do require more education than others.
So if you go through a client scenario, KYC, right, where your client and you basically determine the time horizon, biggest elements, right? Their risk tolerance, and you determine their investment objectives, right? And you basically modeling an approximate rate of return, an average rate of return that they will be looking to achieve, and you measure against it, right? So you're saying, okay, well, other than conventional vehicles, we have, let's say, some balanced funds, let's say we have some individual securities, some individual money products, and then let's add some alternatives. And I'm just kind of trying to model a portfolio as to how our viewers would look at it and saying, okay, well, if I have a little bit of here, a little bit here, a little bit here, it will provide a little bit more diversification. And by doing so, it will optimize your rate of return by getting you X supposedly. And then we will kind of measure it once every quarter, once every 6 months or a year to see how far off or are we on target. Do you use the same type of methodology?
We do to some extent, and one of the things I try and do, I touched on, those large pension mandates, and as much as possible, I try to build and construct portfolios to mimic what they're doing, depending on client situations. But when I talk about how those institutions have less than 50% in traditional, around 50% in the non-traditional, you're looking at private equity, private debt, real estate, infrastructure. So how can we incorporate those? Now, unfortunately, I can't go out and buy the 407. I can't go buy an airport. Right, but
I wish we could.
exact time, they're cash cows, they can absolutely be cash cows.
Yeah.
However, there are opportunities that give you access to them. And some of them are more liquid than others, so some of them, and it's really identifying what makes sense and how do you build that consistent stream of income and or growth. Now, there's no perfect scenario, there's nothing that's gonna give you, up and to the right on a smooth, steady line. But what we're trying to do is construct a portfolio that almost like a duck on water. On top, everything is calm, but underneath, that duck is paddling. There's a lot going on. So it's what is the bottom line? And you want to have investments that are working complementary to another. I've always said I can look at two investments and they can be in completely different sectors. But if their correlation of the way they react to market conditions is very similar, then that's not going to diversify. And you want things that will act differently in different markets so that they're not all going up. If your portfolio is going up, if everything's going up at the same time, you probably have a risk of everything going down at the same time as well. And that's what you want to try and mitigate. So what we try and do really is focus on three, I talk about many buckets, but really it's a three-pronged stool, for lack of a better term. You have your preservation of capital, you have your income, and you have your growth. Now, they can all come from different asset classes. For example, many people talk about real estate being your income, right? You own an investment property or you invest in a mortgage investment book, that's income. It could also be growth because you might be buying a pre-development property that you're hoping that it's gonna appreciate in value.
Expected capital gains.
There's a capital gain, there's your growth. It could also even be preservation of capital. If you're buying a property, potentially it's undervalued or you're getting a good value, that land is worth value. So I'm not saying you generally want to buy real estate for preservation of capital. You probably want income or growth. But within every different type of asset class, you can find components generally of all three of those different cores, and it's how do you construct them overall to find that solid stool.
And to your point, and I'm gonna probably make the last comment and I'll pass it over to Dennis, this is the very importance why when I have a conversation with our clients, when we also have some investors due to what we do is it's so important, especially now more than ever, to have a knowledgeable, experienced portfolio manager like yourself to take the whole picture and develop a holistic plan and kind of balance that rate of return versus risk versus where you should be investing or what you should be aware of, yet providing the needed level of education to make sure that people have the comfort of understanding what's truly within their portfolio, right? And I'm just kind of addressing our audience out there. There's a lot of self-directed accounts, and of course, we all play with stocks and do certain things, but at the end of the day, because we worry and we care so much about our stability in our financial future, we really need to have someone out there looking who's got the best interest at heart for ourselves, looking at our portfolio and recommending needed changes. And that person is doing that job 150% of the time, not part-time, but full-time. This is the importance of having a full manager around you.
Absolutely, and I think taking one step further, it's hopefully taking the emotion out of it as well.
Exactly.
Right, when you're a business owner or you've invested in a stock or any type of investment, you feel close to it.
Yeah.
And we're all the same, you know, even I've had investments that I've come close to and I've been, if you want to call it, emotionally connected to. But it's important when you're looking as a third party is let's try and be rational. Let's look at this from an unemotional aspect and say, is this the right decision at this time?
Absolutely.
And I think that's where, you know, as a portfolio manager, investment advisor, any professional, yes, we have some education, we have some experience, but accessing anyone that is a third party that isn't necessarily, you know, tied to your individual investments is valuable. I think information is very important, knowledge is important, and having those open dialogues, it could be with an accountant, it could be with a lawyer, it could be with a family friend, it could be any of those can add value. Obviously, some positions and some roles have more value because of potentially the expertise and the knowledge, but having that unbiased and unemotional decision making is very important.
That we've come to rely on from all these professionals that do what they're supposed to do, what they've been trained for to do, right?
Exactly.
Let them do all the work. Yeah, absolutely.
Yeah, it's like getting, you know, you're not gonna go see your mechanic if your knee hurts, right?
Yeah. Look, if you do, there's a problem, right?
Yeah.
Yeah, that's right. No, that's great. Why don't we get a little bit more like deeper into now that we've sort of set the stage as it were. I know you were talking about sort of how teachers and some of these institutional players have changed their asset mix. But we kind of dove right into it. Let's get back to that and let's talk about sort of what you're seeing. I mean, I know I've known you personally for a while. I know you've been a big proponent for alternatives for quite some time. But again, like I think you're probably one of the few that picked them up a little bit earlier than some of the other professionals in our industry, right? I think the cat's out of the bag. Like everybody kind of knows what an alternative or non-traditional is. But a lot of advisors still aren't very deeply, you know, using them or portfolio managers. How do you approach, you know, your asset allocation with keeping in mind that it's changed? What do you see? How do you see the industry evolving and really like? I'm seeing growth, which is why I love non-traditionals, but I just wanted to kind of get your thoughts on that.
Well, we're absolutely seeing growth and a lot of growth. We're also seeing the commoditization of some of these investments as well. If you go back, you know, 10, 15, 20 years, everything was through a limited partnership, a private structure.
Yes.
Very difficult to access. Over the last number of years, you've had and then these were the hedge funds and the offering memorandum type funds. Over the last couple of years, we've seen the expansion of the liquid alternative space. So these are prospectus driven investments. Now, they're not suitable for all alternatives. But some alternatives, it might make sense to be in a liquid alternative. And really the big difference between the two, and to oversimplify it really is the liquidity. Whereas many of these offering memorandum structures, and I'm generalizing, will have monthly or quarterly or maybe even annual redemption. The liquid alternatives will have generally weekly, sometimes shorter, but they usually have a shorter liquidity stream. Now, with that comes some benefits. Obviously, you're more liquid. On the flip side, sometimes illiquidity is a good thing. And I know that's a maybe a little bit counterintuitive, but when you're looking at all of your stakeholders, all of your shareholders, all of your investor base, if you have a product, let's go back to, you know, the lovely pre-development real estate opportunity. It's an easy one to explain. You know, if you're buying a liquid alternative or a public vehicle in a pre-development building at, in Midtown Toronto, for example. If it's liquid and you decide tomorrow you want to sell, you can sell and the remaining shareholders are effectively at risk.
Right.
Now, obviously, someone else is buying it, but you really want to match your duration with your risk. So if you're in an investment that has a long time horizon, the investment should probably be fairly illiquid or very illiquid, depending on what it is. If you're investing in a structure that the underlying securities are all S&P 500 stocks, you could probably do something that is daily or even, weekly liquidity, because you're gonna have access to that money, or the manager, the portfolio manager managing it can have access to the funds very quickly. You go back to, mortgages or any type of these investments that have potential redemption dates or maturity dates. You really want to be managing those maturity dates, and that goes back to, when you're looking at it for investors and for clients, making sure it matches the duration, matches the time frame. For clients that need money in 6 months or a year or 2 years, you don't really want to be locking into something that that you can only get out of once every 6 months.
Yeah, and I mean, I think that takes us very easily into the next segue in terms of like actual asset allocation, like, right, I think you would be. You would be allocating smaller percentages to certain illiquid assets, and they're usually within that portfolio, you're gonna have some things that are highly liquid and some things aren't. So maybe you can discuss sort of some of the ways in which you specifically do an asset mix, obviously without talking about specific investments or types of products.
But the first thing is going back to the individual investor and knowing what their objectives are, what their risk tolerance is. That's step one. What is their time horizon? And within all those, you're looking, I'd like to say that we're looking at using the alternatives anywhere from about, I'll say 0, because for some clients it doesn't make any sense. All the way up to probably 30 to 40%. Maybe the odd one could have more, but again, that alternative number and that alternative investment is very broad. It captures a lot of investments. So, you might have a situation where a client wants 10% in private equity, 15% in real estate, another 10 or 15% in non-traditional income producing vehicles. So whether that be private credit, mortgage income funds, etc. Those are all alternative. But depending on the client's, their net worth, their need for capital. Again, if there's someone that has, let's say, no children, mid-40s, mortgage paid off, lots of disposable income,
they're more likely to take a bit more risk.
Whether it's risk or illiquidity, right?
Yeah.
So the risk is tied to illiquidity, absolutely, because it comes with, it's an illiquidity risk. However, for someone who doesn't need the cash flow per se, they can potentially tie up that money more so than someone who is living month to month, right? With someone like that, you're not going to say, let's lock this up for 6 months and hope that everything works out well. That's not a very good, financial plan. Hope and a prayer is not a good financial plan.
But it's also their knowledge about any specific industry and their comfort level. And I mean, we talk about real estate investment funds of various forms that they take, but real estate is probably the biggest asset that one will ever have. And by default, we say, okay, can we buy more real estate if we can? So this comfort level, investing in real estates or putting mortgages, whatever the case may be, comes from that comfort understanding that real estate is not brick and mortar that they can actually physically touch and feel, and gives you greater assurance, right, in that.
That's right. And I think it's with anything in any profession. For example, if you have someone who is in the oil and gas sector.
Yep.
They understand that sector very well.
They're comfortable there.
They're more comfortable adding more to that. Now, where you have to step back sometimes and say you have a lot of risk because of your business or whatever it is, if it's in that sector. Exposure, thank you. Maybe we should look for some other asset classes to diversify, so that if, God forbid, something happens to you and your business, you still have that pool of funds to fall back on, as opposed to everything being in the same bucket again. Why? It could still be 2 buckets, but it's 2 oil and gas buckets or real estate buckets or whatever those buckets are.
And that's a very, very valid point. And again, I want to bring back, especially for the benefit of our audience, the very importance of having a portfolio manager and investment advisor by your side is to be able to look and trigger these type of questions. Are we over leveraged? Are we overweighted in a certain industry? Just because we have that comfort level, does it really mean that we are sticking to the plan and actually trying to achieve our goal? by looking at our portfolio, maybe we need an adjustment.
That's right.
And this is why specifically to your point earlier, you need someone like yourself on the side to say, hey, let's look at it from a different perspective. Let me throw you some facts. Let's develop the comfort level from that perspective.
So what I'm hearing is alternatives are good and they're certainly appropriate for certain situations and certain clients. From the sounds of it, you're using them for most of your clients, I'm guessing, or at least a large portion of them. There's many different types of alternatives. And you know, there's certainly risks, just like with any other investment. So liquidity is one of those things. Obviously, there's going to be the underlying assets are going to be a little bit, because it's a broad field, there's going to be a lot of different risks.
I think the important thing is we've seen the movement to these non-traditional asset classes. That doesn't mean it's for everybody.
Yeah.
I think it's important to educate yourself, whether it's doing it yourself, using an investment professional, and learning about the value of them and if they make sense. Again, they won't make sense for everybody, but I think there is a value to understanding how it could fit into your portfolio and where to use it. And I think that's the one thing I would leave, you know, the audience with is just do your research to see if you have exposure to it, also to understand what your exposure is. I think that's the big thing is it's great to say you own an alternative investment, but make sure you know what you're investing in.
That's,
You know, and we haven't touched on that, but you know, that's probably the biggest risk is, do you know, and that goes to the public markets as well. You can own a mutual fund or an ETF and not really know what you own. And you know, the ETF market has changed dramatically, and that's a whole other conversation, but you know, when it first came out, it was very passive, very basic, very low cost. Your average ETF now doesn't look that dissimilar to a mutual fund.
yeah,
Lower, still a little bit lower on fees, but those fees are for specific reasons, but they're very similar. They're actively managed. They're doing many of the things that the mutual funds are doing. So knowing what you own is very important. And that goes with everything. With not just your investment portfolio, with the car you own, with you know, anything that you've invested time and money into, make sure you understand what's behind the walls of your home.
Don't just take an advice. There are a lot of people who are just interested in giving you advice, and it's interesting because especially in the mutual funds, the neighbor says, oh, I've heard it from him that he made money there, I'll just put my money there.
yeah.
Same in the mortgage industry. When I was a broker, like, oh, I'm gonna go with a 5-year. Well, why are you going with a 5-year fix? Did you consider a 3-year? These are the questions we should be really asking, which would trigger someone to spend more time educating.
And being, I don't want to use the term cynical because I want to be optimistic about the industry and about the majority of people that are, but you know, understanding if someone's telling you that they have a risk-free investment that's going to generate you 12% or 13 or 15.
Take all our money and just jump in there.
Please run away. Run away.
No, and I wouldn't even say run away, but like understand that if the risk-free rate of what you can get for a GIC now is 4.5%, you're getting something that's 15, that's more than 3 times more value.
Yeah.
Does it have 3 times the risk? If it has less, then maybe it's a good investment, but understand that there's no free lunches. I think we all know that.
Absolutely.
And do understand what you own. And I think that's where, and what the risks are. You know, it's great that you can earn 15%, but if you can't get access to that money for 5 years, is that worth the 15%?
And it might be for some people,
Yeah,
right?
absolutely.
Because maybe you don't want that money. Maybe you're putting it into your kid's RESP
Yeah,
or
or
something
an
like
RSP
that, right?
account,
Or a
exactly.
locked-in account, a LIRA.
So again,
right? So
educate,
Yeah.
put some time into learning what you're investing into. Don't just trust the neighbor because they may have a different ideology. Use an investment professional.
Absolutely.
But again, be curious, right? You
Absolutely.
need to be curious. You need to ask your financial advisor what they're investing in and how they're using it and why it's appropriate for you. There's a certain duty that financial advisors have to their clients, right? That's just like the Hippocratic oath that doctors take, there's certain duties that advisors have to explain the products and the portfolio for their clients. And I wanted to kind of segue into that for what you do with your clients, really, like what are the benefits? Like talk about how because that's the one question I wanted to ask, like sort of promote yourself, like tell me why I should give you my money and my tax and all the other things that I worry about every night.
Well, I think one of the things we try and do is just really have, after we go through that planning with you is managing your expectations. So if we're constructing a plan and your goals and objectives are to earn, and I hate putting percentages, because a lot of times we will use some sort of planning and goal planning and cash flow management to determine what your objectives are. If you need to earn hypothetically 5% a year, why are you trying to earn 10%? You know, and I think that's something we all want to make as much money as we can, we get that, but what's important is that risk adjusted return.
Yeah.
But also managing to what you need. So if you need 5% a year, let's try and get to that 5%, because that's gonna help you meet your goals and objectives. If they change, then we change with it, but adding unnecessary risk to a portfolio, I think, is not. There's no real value to it, you know, it may be nice at the, you know, at the Christmas party or the holiday party when you're talking about having that great investment. But at the end of the day, I think many of us, especially I know with myself coming through, you know, the last 4 or 5 years, especially through the pandemic and all that, and realizing how important family is you really want that balance of family and work, and many of us now, you know, it's not, you know, it's work to live, or was it live to work, now work to live, right? You want to have that balance and enjoy the time you have with your family, so make sure you're hitting those right objectives and those right targets. And that's what we're trying to do with how we construct these portfolios, is letting you sleep at night. And, you know, the last thing I'll say is, you know, you could have a portfolio manager or an advisor go through all these things and build the perfect portfolio for you. And this is what for the audience is, if you're not sleeping at night, if you feel that it's riskier than it is, then it is. You know, math is one thing, but the industry, there's a balance between math and science. We can say, sorry, math and science and art, or math and art, you know, we can really sit here and say, yes, we can get you that 7%, and this is what we need to do. But if you feel that it's too volatile, or it's too risky, or you're looking at your portfolio and you're seeing those squiggly lines and they're too big, then you need to step back and say, okay, you know what? I realize that my return might not be as optimal as it should be, but that's what's comfortable for me.
Yeah.
And I think that open dialogue, that's important for your advisor to know as well, that while this might be the right thing theoretically, practically, it's not. And those conversations are important to have, so that open dialogue is critical.
So 3 important things that I took away from this section is understanding your client's needs specifically, hearing their story, hearing their desires, looking at their financial plan holistically, framing a specific portfolio, and educating them around what they need to know as they throw numbers in terms of rates of return. If I'm looking to achieve an understanding that the higher the rate of return, you may have to take on higher risk, and those risks can be either security specific or product specific or market specific, or combination of,
Right.
and having a right balance within your portfolio.
Absolutely.
Any last words?
That's it. I really enjoyed this conversation. Not also from the standpoint of speaking about the portfolios, but also something that I used to do before working for a bank many years ago. And this is so near and dear to my heart. And the last words that I would like to again express to our audience is, educate yourself on investments before you put your money into a specific investment. Number 2, be very realistic with the type of expectations in terms of rates of return. That's very important. So this way you can manage your expectations. And combination of education and having the right professional by your side will give you that comfort level to achieve that ultimate rate of return, and most importantly, achieve your goals and dreams in the future.
Awesome.
Thanks for having me.
Thanks, Yaron. Much appreciated.
Thank you.